For many people, filing a tax return feels like flipping a coin. Some years they win with a big tax refund. Some years they lose and have to write a big check to the IRS in April. Wouldn't it be nicer to take control of the game, tipping the odds in your favor, and knowing what to expect every year? Strategic tax planning can give you that control. This video explains what tax planning is and how it differs from basic tax preparation. It will introduce you to strategies that can reduce your tax bill not just for a year, but for a lifetime. Let's get started by clarifying a couple of key terms you need to know. The phrase tax preparation refers to the process of completing and filing a tax return. The most important thing to know about this process is that it looks backward. Almost every aspect of preparing a tax return relates to things that already happened during the previous year. So when tax preparation services brag about getting you the largest possible refund, it's critical to understand the limits of that promise. Tax return preparers can help ensure that you do not make mistakes like neglecting to claim a deduction or tax credit that you qualify for, or failing to report taxable income. And those things certainly could save you money by ensuring that you don't overpay in tax and also stay clear of IRS penalties. However, the factors that really determine the amount of your tax refund or tax bill are all baked in by the time filing season arrives, resulting from decisions made months or even years ago. In essence, the coin has already been flipped before the tax preparation process even begins. By contrast, tax planning involves looking ahead, anticipating possible outcomes, and making decisions while there is still a chance to change those outcomes. Perhaps a major tax-saving opportunity, like a large credit or deduction, lies just around the corner, but you will only be able to claim it if you take certain steps today. Or maybe an impending boost to your income could result in a big jump in your tax bill, but you have ways to mitigate that impact if you plan ahead. In short, tax planning has two primary components: anticipating the potential tax impacts of a wide variety of events, and deciding which actions will enable you to make the most of tax-saving opportunities and minimize the impact of factors that could increase your tax. Let's first look at some of the main elements of tax planning for a single year, then talk about why the most effective tax planning actually spans multiple years. Dozens of different life events could affect your taxes for a given year. These events may include earned income changes due to a raise, promotion, job change, loss of job, taking up a freelance side hustle, and so on. Unearned income changes, such as an increase in rental income or investment returns like interest and dividends. Marriage or divorce. A change in your family size, such as the birth or adoption of a child. Children growing up so that they may no longer qualify as your dependents or as your qualifying children for tax credits like the child tax credit or earned income tax credit. Moving, selling your home, or buying a new home with a mortgage. Making energy efficiency or clean energy improvements to your home. A household member pursuing higher education, and many, many more. When considering tax strategies for the current year, think also about how things turned out when you filed your last tax return. If you owed a significant amount of tax, you will want to avoid ending up in that same situation next spring. And while it may be exciting to receive a massive tax refund, that refund actually tells you that you overpaid in tax throughout the previous year. Most likely, this occurred because too much tax was withheld from your paychecks. As a result, the government earned interest on your money instead of you. Any of these life events or tax circumstances might mean it's time for you to adjust your paycheck withholding. The IRS provides a pretty handy tool for this purpose called the Withholding Estimator. You'll find a link to that tool in the resources section of this website. If you do not have taxes withheld from your income, for example because you work as an independent contractor, then you may need to adjust your estimated tax payments instead. If you purchase your health insurance through the insurance marketplace, also called the exchanges, the events I've mentioned here could also affect your taxes in a second, indirect way. Changes in your income, employment status, or family size may affect your eligibility for the Affordable Care Act premium tax credit or change the amount of your credit. Such a change could impact both your tax bill and your monthly insurance premiums. Therefore, one key component of annual tax planning is keeping the exchange where you purchased your health insurance informed about any changes in your circumstances. Another major tax planning consideration each year is finding the best strategy to contribute to any tax-advantaged accounts you may have. Examples of these accounts include IRAs, workplace retirement programs, health savings accounts or HSAs, and health flexible spending arrangements or FSAs. For some of these plans, the difference between a well-thought-out contribution strategy and a haphazard one could be thousands of dollars each year. The bottom line here is that getting your largest possible refund in the spring does not necessarily mean that you got your best possible tax deal. Responding to significant life changes when they occurred might have made far greater tax savings possible. Of course, it's hard to keep track of every factor that could influence your tax bill while living a busy life. One way to ease that mental burden is to schedule a tax planning checkup or two each year. These meetings can help ensure that you do not miss out on any tax benefits and do make needed adjustments to your withholding or tax payments all before the coin gets flipped. We often recommend a meeting in late spring or early summer when the stress of filing season has passed, but the outcome of your last tax return is still fresh in your mind. It can also be helpful to meet in the early fall, before the deadline to make changes to your health insurance or to your contribution strategy for an FSA or HSA for the coming year. We would be happy to talk with you about the best checkup schedule for your circumstances. Once you have settled on your best tax strategies for the current year, it is time to widen your view. The most effective tax planning looks years into the future. Let's look at 2 examples to see why. Suppose that during a certain year, Karina takes several classes to improve her job skills, which qualifies her to claim a lifetime learning credit of $2,000 that year. That same year, she installs solar panels on her home, which could qualify her for a clean energy tax credit of $3,800. She also makes several energy efficiency improvements, making her eligible for an additional energy credit of $1,400. For that year, Karina owes $4,200 in federal income tax. The problem here is that the tax credits Karina could claim are non-refundable, which means that she cannot receive any portion of the credits as a tax refund. Once your non-refundable credits reduce your tax to zero, you simply forfeit any remaining credit amount. So in this scenario, the fact that Karina's credits add up to far more than her tax bill means that a significant portion of those credits goes to waste. This table shows how the credits actually work out on Karina's tax return for the year. Feel free to pause the video to review the table in detail. The end result is that while the credits reduce Karina's tax to zero, saving her $4,200, she also left $3,000 worth of tax credits on the table. In effect, she gave away $3,000, and that's money she can never get back. With advanced tax planning, Karina could have identified the risk of wasting tax credits before investing in her home energy improvements. She could have then staggered her investments in education, clean energy, and home efficiency over multiple years, potentially enabling her to claim every dollar of each tax credit. In other words, by strategically timing when she qualified for each credit, she could have gotten up to an additional $3,000 in tax savings over the years. For our next example, suppose that Sean sells his vacation cottage for a price that is $75,000 more than he paid for it. Most or all of that $75,000 gain could be subject to capital gains tax. Capital gains tax is a form of income tax that specifically targets investment profits. 2 years later, Sean sells a collection of artwork that he acquired in the past. Unfortunately, the market for artwork has softened over the years, so Sean has to sell the artwork at a $55,000 loss. The IRS allows taxpayers to use capital losses, like Sean's bum deal on the artwork sale, to reduce their total taxable income, but only to a very limited extent. For the year when he sold the collection, he might only be able to deduct a few thousand of the $55,000 loss from his total income. He may have the option to carry the unused part of the loss forward to future years, but at best, this process would mean taking many years to deduct the full loss amount. The tax rule at issue here is that while the IRS strictly limits how much of a capital loss you can use to offset general income, there is no set limit on using capital losses to offset capital gains. Therefore, Sean could have benefited greatly by selling both the cottage and the artwork the same year. He could have then used the entire loss on the artwork sale to offset much of the gain on the sale of the cottage. So instead of paying capital gains tax on $75,000 one year, and later spending many years trying to slowly use up a $55,000 capital loss, Sean might have only had to pay tax on a net capital gain of $20,000. The resulting tax savings could be substantial, and he would avoid all the hassles of stringing a loss out across years or even decades. In these examples, not having a multi-year tax plan could cost both Karina and Sean thousands or tens of thousands of dollars in the end. Focusing only on the size of their tax refunds for a particular year, when they had already made disadvantageous choices, would be barking up the wrong tree. Importantly, since the goal is lifelong tax savings, long-range tax planning should also take your retirement goals into account. For example, the choice between a traditional or Roth IRA has major tax implications both now and far into the future. A full breakdown of IRA options is beyond the scope of this video. But very briefly, contributions to a traditional IRA are often sheltered from federal income tax, while withdrawals from the account typically get taxed. For Roth IRAs, the reverse is true. Contributions to the account generally get taxed, while qualifying withdrawals may be taken tax-free. The more thoroughly you evaluate your short-term and long-term income and tax prospects, the easier it will be to choose which type of plan is best for you. We would be happy to work with you to develop long-term tax strategies that take into account tax credits and deductions, capital gains and losses, retirement plans, and many other factors. Taking a few planning steps now could pay dividends for decades to come. Summing up, thoughtful annual and multi-year tax planning can help you change that yearly coin flip into a long game tilted to your advantage. If you have any questions or would like to learn more, please get in touch by calling or filling out the contact form. It will be a pleasure speaking with you about your unique circumstances and needs.